Hi, thanks for listening in to our quarterly investment review that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. Now, here's what's on our agenda for today. First, the second quarter saw a continuation of the bull market, particularly in U.S. large cap stocks. Now, the economic expansion, that's persisted despite weakness in many traditionally effective indicators. We're watching the job market very closely here as for cues to what could happen going forward in the economy. Now, there have been some positive technical developments of late, and the macro backdrop does continue to support an overweight to stocks. So we're going to talk about that a little bit as well. And finally, we'll give some election perspectives to round things out. So here, let's start with this. This is a table showing the returns of select asset classes. Now, let's just narrow in here on the last two columns. We can see here that in Q2, emerging markets and large cap domestic stocks were outperformers. Now, that adds onto the respective bull markets year to date. Commodities have been positive this year, and those small caps and developed market stocks were down on the quarter for Q2. They remain positive this year as well. And bonds were steady in the second quarter. Now, we like to start many of these presentations with this chart because it's really a good roadmap for where we are in the cycle. I've shown this in most webcasts that I've done in the last few years. And what we're showing here in the top clip, it shows the typical stock market cycle, while the bottom clip shows the typical economic and earnings cycle. Now, to cut to the punchline, you are here. Stocks are in a bull market that's supported by positive economic and earnings growth. Now, we would not expect the next bear market to occur until the economic and earnings cycle is about to turn down. Now, the market and corporate fundamentals are following a very typical post-bear market pattern. Remember, we did have that bear market in 2022. Now, the market rallied strongly in 2023 and has moderated somewhat this year, but continued its advance. What this chart here shows is the average pattern for stocks in the middle clip in black. Now, typically, the advance would be driven by rising valuations in the bull market's first year. And that's exactly what we saw in 2023. Then eventually, the bull market would be supported by stronger earnings growth. And that's what we're seeing here as we move on into 2024. Now, here's what's going on with earnings. The orange line in the second clip is year-over-year earnings growth. We can see that the earnings contraction hit its worst point at the end of 2022, and earnings growth is now positive. In Q1, earnings grew 9.3%, and they're expected to grow 18.3% by Q1 next year. Now, earnings are currently supported by really solid economic growth. Now, we get a GDP report later this week, but ahead of that, the Atlanta Fed's real-time tracker is expecting about 2.7% economic growth in the second quarter. Now, that's very solid for the behemoth that is the U.S. economy. This growth is primarily being driven by consumption trends. Now, earnings are also supported by expanding profit margins. Here in this chart, we're showing profit margins for the S&P 500. Note that margins contracted when inflation was very high in 2022, but have since begun to rebound. Companies have done a very good job controlling expenses and passing on those higher input costs. Now, what's been really interesting in this cycle is that many economists have persistently called for recession really since early 2022. We think that they've been too focused on traditional indicators and not focused enough on these unique aspects of this cycle. So here in this chart in blue in the top clip, we're showing a proxy for the economy itself. In orange, we're showing the Conference Board's leading index of indicators. Now, the leading indicators have been contracting, and historically, that would be consistent with negative economic growth. The problem is that many of the leading indicators are very interest rate sensitive. Things like the yield curve, manufacturing activity, the housing sector, these are all examples of traditional leading indicators, but those have not worked in this cycle. And that's largely because the economy is dominated by consumer spending, and households have been well insulated against higher Fed policy rates. In fact, A mortgage is the largest debt for most folks. Now, mortgage debt is 10 times greater than credit card debt here in America. What we're showing here in the dark green line is the 30-year mortgage rate. The light green line shows the effective rate on all outstanding mortgage debt. Now, it's risen, but not by much. Now, another consumer cushion has been excess savings from two big pandemic stimulus programs. Now, this chart in blue in the top clip shows the total dollars of annual savings. The orange bars in the bottom clip are an estimate of how much more savings we have among households than we would have had without the pandemic stimulus. Now, excess savings are dwindling, and maybe that's an issue for another day, but we need to remember that consumers are still saving, and they still saved $800 billion in May at an $800 billion rate. All right, now turning over to household debt. So this is something that we've heard a lot about in the news, is that the credit card debt levels are really rising, and that's problematic. Now, we have to remember that the total dollar amount of debt is almost always rising. So don't let people scare you with just large numbers themselves. You have to normalize it, and you normalize it to the ability of a household to service that debt. So in orange, we're showing debt as a percent of income. Note that the household deleveraging cycle, that's really still ongoing. And as a matter of fact, when we look at debt relative to GDP, we can see that, or relative to income, we can see that debt actually contracted over the last year. And that's something that you probably wouldn't hear the doomsayers tell you much about. Now, as consumers have delevered, we've also seen inflation ease. Real income growth turned positive, and it's remained so. This chart shows both the Atlanta Fed's wage growth tracker as well as the government data on average hourly earnings. Both series are net of inflation. So first, looking at this chart, it's easy to tell why American households are so unhappy in the survey data that we get. They lost real purchasing power throughout 2021 and 2022. But as we're showing here, there was a turning point in the middle of 2022. Households haven't fully caught up to those real losses of purchasing power in the prior years. And this chart does explain a massive challenge for the Democrats in November. And we'll have more on that later. But nevertheless, today, real income growth is positive, and that remains supportive of consumption and therefore economic growth and corporate earnings. So rather than those traditional leading indicators, we're focused much more on the job market right now. Unfortunately, the labor market is more of a coincidence rather than a leading indicator, but it's probably the best we can do for this cycle. What we've seen thus far is a continued normalization in the labor markets. Now, the blue line in the top clip and the orange line in the bottom clip of this chart, those are the same. It shows the number of job openings relative to the number of unemployed workers. Now, at its tightest, the labor market had 2 job openings per every 1 unemployed person. Now, that has fallen to 1.2 today, which is still somewhat of a tight labor market, but much less so than it was a few years ago. Now, the dashed orange line in the top clip shows wage growth. It's tracked almost perfectly to the job openings data. Now, the bottom clip is where we can see how the job market is basically normal now. The dashed line in the bottom clip is the difference between wage growth for folks who switch jobs and wage growth for folks who stay in their job. Now, the difference is now back to the average that we'd seen in the years before the pandemic. So in short, a lot of the froth has been removed in the labor market. That's taken some pressure off inflation, but it does probably take away some of the cushion that the economy had over the last couple of years. Now, here's another perspective on why the job market is so important today. The blue line here is the yearly change in payrolls. We can see that the economy continues to add jobs. The orange dash line is the annual change in consumer spending. Now, that's been the main driver of economic growth in this cycle. You can see that both are pretty comfortably above zero. The bottom line is that if you have a job, you're probably going to continue to spend money. So if payroll growth turns negative, we'd be much more worried about the economy at large. For now, trends look okay to us. Now, turning to recent market trends, we would note that market technicals have shown some improvement lately. So here in orange, we're showing all investable US stocks relative to their own average price of the last 50 days. A few days ago, about 70 stocks traded above their respective average levels. That's a pretty solid sign. But we'd want to see 90% participation to have strong conviction that the bull market has at least another year to run. We haven't quite gotten there yet. Now, that said, for today, the broad macro backdrop remains supportive of an overweight stance towards stocks. Now, in the chart on this slide, the top clip in blue is the stock market. The middle clip in orange is the leading index on the economy. And the light blue line in the bottom clip is inflation. We can see that the economic indicators are hooking higher and that inflation hooked lower and has now stabilized. And it turns out that that is a very solid combination for stock market returns. And that's what this table is showing on this chart. It's a matrix of historical stock returns under different growth and inflation scenarios. Today, growth is rising and inflation is stable. And that has historically corresponded with about a 17% annual return in stocks. Now, really, the worst zone for stocks is negative growth and deflation. Now, that could happen eventually, but does not appear to be the case now. Now, as for what sort of stocks tend to do the best in bull markets, here's an interesting chart. It shows a strategy of buying stocks in which analysts expect the most price appreciation over the next year, and shorting the stocks where analysts expect the worst price appreciation in the next year. Now, this particular line is the average of that strategy around all bull markets. It's one of the better historical strategies for stock picking in a bull market. Typically, analysts expect stocks to perform well when they have strong sales, earnings, and free cash flow growth, as well as high expected growth. Today, those stocks are primarily concentrated in growth sectors like consumer discretionary and technology. Now, more specifically, most of the so-called Magnificent Seven or Mag 7 share these characteristics. Here we can see the aggregate of those 7 stocks and their trailing earnings growth in blue in the top clip and their forward earnings growth expectation in blue in the bottom clip. Now, the orange lines represent the rest of the market. Clearly, the rally in the Magnificent Seven is at least somewhat justified by better fundamentals. But those stocks have generally gotten pretty expensive based on valuations. We suspect they could be hit pretty hard in the next bear market, though we don't believe a bear market's likely at this time. Here we're showing one of the better strategies for selecting stocks in a bear market. If one bought the cheapest stocks based on price to earnings ratios and shorted the most expensive stocks, they would have done well during bear markets of the past. Today, the least expensive stocks based on PEs reside in the value sectors like financials, energy, and industrials. Now, tech and healthcare, growthy sectors, have some of the most expensive names, as I alluded to, and the Magnificent Seven as a group are pretty pricey now as well. Now, we have ample exposure to those mega cap growth stocks, but we're only market weight in our strategy because of their elevated valuations. Finally, let's end with some election perspectives. Now, here we're showing the average quarterly return in the election cycle. Note that election years have generally been good, and Q3 in general has been particularly strong. Now, the data is a little different when the incumbent party loses or when the sitting president is not up for re-election, which is now the case. Regardless, despite the uncertainty of an election, the election year itself has not historically been something to fear. Now, here we're looking at the latest prediction markets. The most recent line on prediction betting markets like PredictIt currently favor Trump to win in November. Here we can see that his win contract is trading at 62 cents. So not a slam dunk, but a comfortable favorite at this time. Now, following the debate, the market started quickly pricing in a Trump victory as well. Now, this chart is pretty noisy, but the top clip shows the best performing industries following the debate. And the bottom clip shows the worst performing industries following the debate. Now, among the best were banks, consumer finance, and trading companies, which would all benefit or could all benefit from deregulation. Among the worst were textiles, apparel, and luxury goods, which could all be negatively impacted from an expansion in tariff policy. One interesting note is how quickly the market prices in election scenarios. If Trump's lead grows up into November, there may not be any Trump trade left to capture by the time the election rolls around at all. Now, that would be consistent with what happened in 2016. Right after the election, a similar Trump trade emerged, but it didn't stick around. Here in this chart, we're showing sector performance in the duration of Trump's first term. Note that tech was the top performer, followed by consumer discretionary. Energy was the worst performer. Interestingly, though Trump was favorable from a regulatory perspective, energy companies did not show much capital discipline. Instead, they increased oil production, which drove down the price of oil. This cycle, we expect energy companies to be much more disciplined, even if they face less regulation. Now, one popular narrative going around is that tariffs would be inflationary. They might be, but we think that's far from a given. Interestingly, this chart shows import prices from China in blue and the tariff rate on Chinese exports, and that's inverted in red. Note that Chinese goods have gotten cheaper as tariffs went up, not more expensive. Now, that's not been true for US goods manufactured in China. Those have gone up in price as US companies have passed along these costs more effectively. But it is highly questionable that further price increases could be absorbed today. Regardless, we can think of tariffs as a tax on someone, which will lessen spending power in other areas for whomever pays it. And that's ultimately a deflationary force. Now, another popular narrative is that another round of tax cuts would be stimulative. If Trump wins, it's probable that the Tax Cuts and Jobs Act provisions would be extended or maybe even made permanent, but the scope for additional tax cuts is hampered by ballooning budget deficits. Here, this chart is showing debt relative to GDP in the top clip, and the bottom clip is showing net interest payments along with projections. It may be difficult to get more tax cuts through. That's especially true for corporate taxes, where Trump's voter base is getting increasingly less trustful of big corporations, according to recent polling. Now, here we thought it would be a good exercise to take a look at some impactful data and where that data stood at the end of 2016 and where that data is today. And in doing so, you quickly realize that whoever wins the election will face a tall order in replicating market returns of the past 8 years. First, the S&P 500 ended 2016 with a PE ratio of 23.7. Today, it's almost 4 points higher than that. Profit margins were 9.2% in 2016, leaving room for some margin expansion. Today, they're near all-time highs at 11.4%. Of course, profit margins could expand further, but it's going to be a challenge. The current valuation is decently higher when you consider the discount rate of today. In 2016, 10-year Treasury yields were 2.5%. Today, yields are 4.3%. And then, as we alluded to on the last slide, the scope for a much more attractive tax rate is probably greatly diminished. In 2016, the top corporate rate was 38%, and it's 21% today. The top individual rate is also down, though not by as much. The budget deficit was $581 billion in 2016. It's about $1.6 trillion today. Again, it's not impossible to achieve solid market returns, but it's going to be quite difficult to replicate what we've seen in the last 8 years, given a much more challenging starting point. So, summarizing the key points, we think we're in a bull market that's likely to continue until we close in on the next recession. The evidence is not pointing to a recession today, and with economic expansion, we're seeing an improvement in corporate fundamentals. The major data signals are likely to come from the labor market. Real incomes are rising, that's a good thing, and jobs are still being created supporting consumption. We'll have more to say about policy as we get closer to the election, but for now, Trump looks like the favorite today. Market action agrees with the prediction markets. Regardless of who wins, they're going to face a difficult task to replicate the strong returns of the last 8 years, given a more challenging starting point. As always, we're open for additional questions. If you have them, send them our way. And again, thank you so much for joining us and listening in.